Greetings and welcome to our newest Sovereigns podcast. I am Joan Feldbaum-Vidra and I look after sovereigns for KBRA. With so many new macro prints out, we thought we'd host another podcast to inform you about how we see credit risk evolving in the sovereign space. As always, data prints in the US and China are particularly important to follow in terms of what it means for the global economy in big picture macro terms. In addition, commodity prices are another thing to follow in sovereign risk. I'll comment on all of these and let you know what we're thinking. Plus, I'll also comment on Europe and share with you some new findings about energy resiliency. First, the main global macro prints. In the past few weeks, we've seen the U.S. print CPI that's still rising gangbusters by all definitions, but it is falling from its highs. Much of the reduction has come from energy prices, and we're all enjoying our visits to the gasoline pump these days a little bit more, with core inflation still elevated and contributing to above target inflation. Estimates are about a third of the inflation is from non-core factors. We've also had a GDP release for the second quarter. The second read was released today, August 25th. And that read confirms that the U.S. is indeed in a technical recession. We've had a GDP contraction quarter over quarter for both Q1 and Q2, led primarily in the recent quarter by a contraction in residential investment. Investment is down over 13% in real terms, while private consumption continues to expand. So while it doesn't exactly feel recessionary to the consumer, perhaps, despite the inflation in Q1, it is starting to feel more recessionary in Q2, but only somewhat because the labor market continues to march ahead with good prints. Same goes for retail sales, although we are starting to see that in real terms, this is beginning to weaken. The Fed is watching all of us, and I invite you to listen to our chief strategist, Van Hesser, his podcast on what the Fed might be thinking in his regular 3 Things in Credit that he releases every week. He oftentimes touches on that topic. What else? The dollar continues to strengthen thanks to divergent monetary policy among the largest global central banks. And that's a negative for many global sovereigns who pay for commodities in US dollar. And all the while, the weakening of their exchange rates amplifies the inflation threat. As far as the euro weakening is concerned, that's something that's definitely made lots of headlines. That obviously doesn't boost the bloc too much in terms of competitiveness because of the intra-regional trade among those economies. But other economies outside of the euro bloc might gain competitiveness from weakening exchange rates, but that's at a very large cost of battling inflation and shrinking economies. Not generally a great trade-off. And what else? Well, China's released some prints and it also has loosened monetary policy. China still has, like many Asian economies, a lower inflation print than what we're seeing in the US and in Europe and in the UK, much lower. GDP growth is not marching ahead very fast, will probably be south of 4% during the year. Many analysts are warning that. That is a far cry from the double-digit growth rates that China posted in the 90s and in the early part of the millennium. Policy in China is decidedly accommodative, but not sufficient to rev up the Chinese growth engine in a meaningful way, and that's generally not positive for sovereign credit. And on to commodity prices. Here we have a lot of volatility and also generalized downward momentum in prices, mostly across the board. And in terms of the impact on sovereign risk, where you stand is where you sit. So if you're a commodity producer, you'll be feeling the ups and downs, but enjoying the elevated prices. And if you're a consumer, well, you're feeling it in the opposite direction. Brent is down, wheat is down, lumber is down, all of these things are down. That helps dampen the downward pressure on growth, but to the extent it reflects a growth deceleration and global demand deceleration among the world's biggest economies, that's quite negative for sovereign risk. And as we've been saying repeatedly over the past year, I think, the pressure on food prices and on commodity prices is very, very heartfelt among weaker emerging market economies and definitely amplifying risks there. However, in the uncertain environment with lots of speculation about how fast and significant Fed hikes will be, there has been some return of flows into the emerging markets, but it's very weak and not at all stimulative yet to emerging market demand in a meaningful way. Now let's turn to Europe. There's no surprise that conditions are very strained in Europe, but energy conservation and hesitant consumer behavior are dominating the scene. And what that means is obviously growth is very much stalling, but resilience is being built. Gas inventories are being built up in Europe, and this shows that conservation efforts and the ability to diversify sources of energy is well underway. And it's also important to mention that there is quite a bit of divergence within Europe. For example, Portugal is at full storage capacity for gas, and some countries have made terrific strides in diversifying away from Russian imports, including Italy. And back to gas storage levels, next to Portugal, Poland's numbers are very, very high, Sweden's as well, and Denmark too. And at the other end of the spectrum, those with the lowest gas storage levels are Croatia, Austria, Hungary, Bulgaria, and Latvia. Interestingly, Germany's storage levels are above the EU average. That doesn't seem to be very well publicized. But notwithstanding that, the cost of the energy shock to Europe is formidable. The cost of energy imports has risen from an average of about 1.6% of GDP to well over 6% of GDP in just the last few months. Europe is very likely headed towards a recession, most likely in the fourth quarter of this year, perhaps even earlier, but most economists are predicting it to be rather short-lived. To be determined, of course. So to wrap this up, what does this mean for sovereign credit? Well, it's not rosy. The slowdown in the U.S., Fed hikes, the strengthening U.S. dollar, commodity price volatility, elevated food prices, and the enduring war are decidedly negative for sovereign credit risk. Although many sovereigns, even if not all, do have a strong ability and flexibility to be resilient to this new shock. Thank you for listening. And as always, please do reach out to the team with any questions or comments. Thank you so much. Bye-bye.